Welcome. Planning for retirement is stressful enough without adding on all the complexities around how your income will be taxed. In this video, you're going to make huge strides in your understanding around how Social Security plays into that retirement tax picture. And you'll be one step closer to being completely comfortable coming up with a strategy for yourself. Let's get into it. Social Security is the largest retirement program in America and is responsible for more than half of the retirement income to nearly 27% of American retirees. It's essentially a government-sponsored pension plan, meaning that a person that pays into Social Security is guaranteed an income for life. That's powerful stuff, especially when you consider that Social Security is one of the last retirement products that is truly cost of living protected. You don't get a choice on whether you want to participate or not. Participation is determined by the type of employment you have. Social Security is funded through payroll deductions and self-employment tax. The tax is known as FICA. The FICA tax is a combination of Social Security and Medicare tax. The Social Security portion that is withheld is 6.2% of gross income for W-2 workers and 12.4% for self-employed entrepreneurs. The Medicare portion is 1.45% for W-2 and 2.9% for self-employed. There are some other nuances on these taxes, but I'll go into more specifics in another video. For now, the important thing to remember is that it's this tax that funds your future Social Security benefit. More than half of workers approaching 62 feel a lot of uncertainty around the decision on when to claim Social Security. Not to mention all the other complexities that may come along with that decision, like if you were previously married, or are you a widow, and whose benefits should you claim. These are all factors that can serve to complicate this seemingly simple decision. Here's what's important to know. 62 is currently the earliest that someone can claim their Social Security. Because currently full retirement age is 66 to 67, depending on when you were born, claiming early will come at a reduced benefit amount to you. If you find that you do not need your benefit at your full retirement age, you can defer and increase your benefit amount. The max deferral period is to age 70. You can defer longer, but your benefit will not increase. So it doesn't make sense to defer beyond age 70. However, maximizing your benefit amount can do a lot to improve your overall financial position in retirement. So if you're healthy enough and can afford it, it almost always makes sense to defer as long as you can. I'll cover that in more detail in another video as well. But that's not why you clicked this video. Let's go ahead and talk about how your benefits get taxed. I like to describe Social Security as a tax advantage income source because the overall tax treatment provides more of a benefit than that of, let's say, a 401k or 403b from a purely tax planning perspective. However, when Social Security is taxed, it is added to your ordinary income tax rate, which is currently anywhere between 10 to 37% in 2023, and is dependent on your tax bracket as determined by other income sources. Also, not all of your Social Security benefit is included in your taxable income. Currently, a maximum of 85% of your benefit can be included, which means that 15% of your benefit will never be taxed. The amount that is included in your income tax is based on your other taxable income sources, plus any tax-free municipal bond income. It is possible that some retirees will have none of their benefits taxed in a given tax year. Again, this depends on how they structure their withdrawals. I'll give an example of that in a moment. In short, there are three calculations that are ran based on your filing status and your combined income amounts. Combined income is determined by the assets you withdraw or earn to support your lifestyle in a given tax year. After the three calculations are ran, the one with the lowest result will be added to your taxable income. Let's look at this in action. I created this spreadsheet to help people who are nearing retirement or in retirement be more strategic about where they pull their money from. We're going to start by just putting in some information here. Remember, marital status is important in determining how our income is taxed. Now, I've already populated some information. We're going to assume that Jane and John need $100,000 of income this particular tax year. And depending on where they pull that money from will depend on their overall tax treatment. This table to the right is what we're going to use to understand their overall tax liability. But first, let me fill out this table at the bottom. And we could just copy that down. They need $100,000. Let's assume that they do like a lot of retirees, pull as much of the money from their 401k as they need. Let's say we pull $50,000 from Jane's 401k and $50,000 from John's 401k. We have $100,000 of income. We have a 12.6% tax rate. They're married, filing jointly, which means in order to live off $100,000, we need to withdraw $112,000 from the portfolio because $12,000 is going to taxes. But let's see what happens if we pull half the money from Social Security and the other half from the portfolio. So let's change these to $25,000. In the same scenario, we have $100,000 of income total. Our taxes were dropped to 9.44%. So in order to live off $100,000, we only need to withdraw an additional $9,400. So again, we just saved 3% by having the benefit of Social Security because again, Social Security is a tax advantage account. What happens if we further increase the amount of Social Security that we have and decrease the amount that we take from our 401k? Let's change this to $18,000 from the 401k, $32,000 from Jane's Social Security. In this scenario, the income tax liability was further reduced. Now we're down to 7% because we got more of our money from our Social Security, which is tax advantage. I'm going to take this one step further, then we're going to get back to it. Suppose this came from a tax-free source. Let's say that you have a Roth IRA and we pull $18,000 from there instead. Well, if one person has a Roth, we just drop down to a 3% tax bracket. So now we only need to withdraw another $3,000 to live off $100,000. But if John also has, let's say, cash value life insurance, another tax advantage product, look at that. They're able to live off $100,000 with effectively no taxes. Let's jump back to it. As you can see, there's a lot that can go into deciding where to pull money in your retirement years, but there is plenty of help out there and you don't have to do it alone. What I want you to take away is that the best way to control your tax liability in retirement is to 1, maximize your Social Security benefit, and 2, increase your tax-free income as much as possible. In essence, understanding and paying attention to your Social Security and other assets can help you to build a secure retirement, reduce your overall income taxes, and increase the money you can spend on the things you enjoy or leave a larger legacy to your family. There you have it. You now know more about how your Social Security benefit is or will be taxed in your retirement. I hope this video helps you be more intentional with your retirement distribution plan and adds tremendous value to you and your family. If you found value in this video, share it with a friend or loved one. Give them the gift that was given to you. I would love to hear your thoughts and answer any questions you may have. If there was something left unanswered and you'd like to see a video on it, let me know. Hit the thumbs up, subscribe, and hit that bell icon so you're notified when the next video is posted. This was another video by Alter Altitudes, and remember, the only limits that you have are the ones you put on yourself.